All right. So now I'm going to talk to you about the exchange differences which are to be included in borrowing cost. So we discussed the concept, right? This exchange difference very briefly to say that if you borrow money in your currency, in a currency which is not your functional currency, but you have borrowed money in a foreign currency, you will end up borrowing money at an interest rate which is lower than the interest rate which you pay in your functional currency. However, then you are exposed to the currency risk. If you are exposed to the currency risk, the standard permits you to also look at that currency loss. If you have, there also a possibility that you actually may have a currency gain, right? If you have a currency gain, that anyway straight away goes to profit and loss account. That is not required to be considered under Ind AS 23. However, if you have a currency loss, then that loss, to the extent of the interest which you have saved on your foreign currency borrowing compared to a domestic borrowing, that is eligible for capitalization. And then there are some more complexity to say that if in one period you had a loss, in subsequent period you had gain, how do you deal with all of that is what we will try and understand. So for exchange differences required to be treated as borrowing cost, the manner of arriving at the adjustment stated therein should be as follows. Amount of the exchange loss not exceeding the difference between the cost of borrowing in functional currency when compared to the cost of borrowing in a foreign currency, right? And we try to explain this with the help of a very simple example to say that if I were to borrow $100, and let's say rupee dollar exchange rate is 50, that means I wanted to borrow 5,000 Indian rupees. Now I can borrow, if I were to go to a bank in India, the bank will say 5,000 rupees, I'm going to charge you interest at the rate of 10%. Here I went to an overseas lender and say I want $100. That bank said, okay, I can give you $100 and I will charge you interest at the rate of 6%. The 4% delta, right? The 4% which I have saved between this 10% and the 6%, right? Now we are talking that this 4% saving, the 4% saving which you have made, now this 4% saving, if this 4% saving which you think you have made, you are now exposed to the currency risk. You are exposed to the currency risk. Now in this currency risk, there is a possibility that you may lose money, you may gain money. Now if you were to lose money, your losses to the extent of this 4% is what can also be considered as borrowing cost, which is eligible for capitalization under the Ind AS 23 model. So we will try and understand this. Now, if there is an adjustment of exchange loss, adjustment on account of exchange loss, adjustment of exchange loss shall be the difference in your cost of borrowing in functional currency versus cost of borrowing in foreign currency. Let me just try and do this. Yes. Let me just clean this stuff for you so that you can see this. Okay. All right. So now the adjustment of exchange loss shall be the difference in cost of borrowing in functional currency versus cost of borrowing in foreign currency. So in my example here, this 4% is nothing but the difference, the cost of borrowing difference in your functional currency versus cost of borrowing in the foreign currency. It is what is to be considered. It is what is to be considered. And we will try and understand this, right? We will try and understand this with the help of an example here. ABC Limited has taken a loan of $20,000, right? $20,000 on April 1, 2019 for constructing a plant at an interest rate of 5% per annum. I'm going to pay 5% per annum. How much I borrowed? 20,000. When? April 1, 2019. Payable on annual basis. On April 1, 2019, the exchange rate between currencies, which is $1 to INR, was 45. The exchange rate on the reporting date, that is March 31st, 2020, is $1 to INR 48. These are assumed rate. These are not the actual rates. Please, consider that as well. Okay, these are assumed rate given in the question, which was on April 1, 2019, $1 was equal to $45, whereas on 31st March 2020, now the rupee dollar has moved, which is $1 equal to rupee 48. The corresponding amount could have been borrowed by ABC Limited from State Bank of India in local currency at an interest rate of 11% per annum as on April 1, 2019. So it was possible for me to borrow this if I would have borrowed this in my local currency, which is INR, then the rate of interest would have been chargeable at the rate of 11%, which I have actually decided to borrow money in foreign currency, and I am actually paying a rate of interest of 5%. So how much is what I am saving here? 11%, which possibly would have been the rate of interest if I had borrowed money in local currency, versus I am paying 5%. So actual is, my saving here on interest expense is 6%, but this has resulted into me being exposed to currency risk. I'm now exposed to currency risk, and when you see this exposure, how is this currency risk exposure? On the date when I borrowed money, actually the rupee dollar was 45. Now on the reporting date, the rupee dollar has moved to 48. So 3 rupees is what I have to now pay more to the bank for me to discharge my dollar obligation, and that's the exchange rate risk which I am carrying because I borrowed money in a currency which is other than my functional currency. So the question here is, compute the borrowing cost to be capitalized for the construction of plant by ABC Limited. So how much is the borrowing cost which is eligible for capitalization in this example? So how much money I have borrowed here? 20,000. What is the rate of interest I am paying? 5%. Now we are talking about 1 year period. The information in the question is 1 year period. Now when I borrowed money, the exchange rate was 45. At the end of the year, the exchange rate is 48. Now what is the rate at which I could have potentially borrowed money if I were to borrow money in Indian rupees? That is 11%. Now, and then what is it I said is that what type of borrowing cost which are eligible for capitalization? Interest cost, which is directly, which is 5%, what you are paying, that is eligible for capitalization. And also the foreign exchange loss to the extent of interest which you have saved because you have borrowed money in a foreign currency, to that extent of exchange loss which actually represent the amount of interest being saved because you decided to borrow money in a foreign currency and hence got yourself exposed to a currency risk, that to that extent is also eligible for capitalization as an interest cost, right? And that's where the classification also happens in the P&L accordingly, right? The exchange loss, to the extent it represents the amount of interest saved, that gets classified as part of interest cost, and the balance gets classified as part of exchange loss. And here's we need to compute how much of that is actually interest, which is eligible for capitalization. So let's look at this solution, right? The borrowing cost needs to be determined for interest on foreign currency and eligible exchange differences, if any. So $20,000 at the rate of 5%. How much is my dollar interest? Is 1,000 converted into 48. So 48,000 is what I'm going to pay, assuming that is what I'm paying at the end of the year. Now increase in the liability. So how much I borrowed? $20,000, right? And when I borrowed, the rate of the rupee dollar was 45. At the end of the year, it is now 48. That means there is a 3 rupees, right? 3 rupees is the difference, right? How much I had borrowed? 20,000. 20,000 into 3 is 60,000 is the amount of foreign currency loss, because it's a liability, right? When I borrowed, it was 45. Now it has gone up to 48. Had this been an asset, had this been a recoverable, then this would have been a situation of a foreign currency gain, right? But here, since I have to pay, and now I have to pay more rupees, I have to pay more rupees, and hence it's a case of a foreign exchange loss. Now, interest that would have resulted if the loan was taken in Indian currency. Now, you have remembered the information which has been provided here. If I would have borrowed in Indian rupees, my rate of interest would have been 11%, right? Now, how much money I was trying to borrow? $20,000. What was the exchange rate prevailing at that point in time? 45, right? 45 into $20,000, right? That is what I would have tried to borrow, which is 20,000 into INR 45 at the rate of 11%, which is 99,000 was the total interest which I would have been exposed to. 99,000 was the total interest I would have been exposed to, right? If I would have borrowed money in local currency instead of borrowing money in a foreign currency. But I wanted to borrow money in foreign currency, right? So I borrowed actually $20,000. Now what is the question here is that one is the direct interest, which is 48,000, that anyway is eligible for to be considered for the purpose of capitalization. Now I need to determine how much is the exchange loss. How much is the exchange loss? Total exchange loss was 60,000. If I would have borrowed the same money, how much my interest expense would have been? 99,000. So how much is the interest cost which I have saved? Is nothing but 99,000 minus 48,000, right? This is the interest is what I have saved, which is 51,000. I have saved how much? 51,000, right? And if that is the amount of interest which I have saved, which is 51,000 in this example, in this solution, right? How much is the exchange loss which I have incurred? The amount of exchange loss which I have incurred is 60,000, right? However, only the exchange loss to the extent of interest saved. How much interest I have saved? 51,000, and to that much is only to be considered as part of my borrowing cost. So the borrowing cost which could potentially be considered for capitalization is 48,000 plus 51,000, which is 99,000, right? In other words, instead of, if I would have not borrowed money in foreign currency, whatever the cost of borrowing of that in Indian rupees, that is what is eligible for capitalization. Now this, you got to this answer here because the foreign exchange loss here was more than the amount of interest which you were able to save. Now if I were to change this example to say that instead of a 3 rupee loss on your borrowing, your actual loss was, let's say, only rupee 2, right? If you would only incurred a loss of 2 rupees, that means your foreign exchange loss would have been, instead of 60,000, would have been 40,000. If your foreign exchange loss would have been 40,000 and not 60,000, then how much your interest outflow, how much your interest which was eligible for capitalization, assuming the rate of conversion is 47 here, that means this will not be 48,000, this will be then 47,000 here, and then you kind of lost 40,000 here. So this 40,000 if you see is actually lower than the 51,000, right? If this 41,000 is lower than 51,000, this 40,000 is what you would have added here, then this would have been how much? 87,000 instead of 99,000. So it all depends upon the exchange rate movement and whether the exchange loss is higher or lower than the actual interest which you have saved because you decided to borrow money in a foreign currency instead of borrowing money in a local currency. And now the amount of saving I had in this example was 51,000, whereas the actual loss was 60,000. That is why it was capped at 51,000, which can potentially be considered as an interest cost. However, if your actual loss was 40,000, then interest can only be considered up to 40,000, not beyond, because let's say if I would have borrowed money in Indian rupees, I had to pay 51,000, hence that is eligible for capitalization. No, it doesn't work that way, right? It doesn't work that way. So you need to understand this very, very clearly. What is to be considered as part of the interest cost is what is you been able to save, and then what you saved, then you got to compare this what you have lost because of the exchange rate risk. If the amount of loss is lower than the amount of interest which you have saved, then the lower of the two is eligible to be considered for the purpose of capitalization. If the amount of loss is higher than what you have saved as an interest cost, then you have to cap up to the interest which you have saved is what is to be considered for the purpose of capitalization. The exchange difference of INR 51,000 has been capitalized as borrowing cost, and the remaining INR 9,000, this INR 9,000 will be expensed off in the statement of profit and loss account. So exchange differences to be included in borrowing cost are unrealized exchange loss treated as an adjustment to interest, and subsequently there is a realized or unrealized gain in respect of the settlement or translation of the same borrowing. The gain to the extent of loss previously recognized as an adjustment should also be recognized as an adjustment to interest. Let me explain to you. I mean, we have an example as well, but I'm going to just quickly take a minute and help you understand this, right? Now, if you look at the same example which we talked about, right? I had this, on 31st March 2019, when I borrowed this, it was 45. Then on 2020, it was 48. That means there was a loss of 3, right? Now, if I fast forward this to 2021, it is possible that it may go back to say 46, right? Now here, from this period to this period, now there is a gain. This is a gain and this was a loss, right? Assuming this loss 3 is what I have capitalized, then what we are simply saying that this 2 gain which has happened in this period, you are actually required to decapitalize the interest cost which you capitalized in the previous period, provided the construction period is still on. Now, if the construction period is complete here only, then you stop. It doesn't matter to me now anymore because it is no longer a qualifying asset. Now, if a qualifying asset continue to exist in relation to which you had capitalized this, now that then this 2 rupee gain, you got to then decapitalize the previously capitalized amount. But if the construction is complete, you are done. From that perspective, or if you've already repaid the loan, then anyway you don't get any foreign currency gain here, so on and so forth. So you got to understand this concept very. Now, assuming let's say this actually instead of 46, this actually has become 44, right? That means I have a 4 rupee gain with reference to 45. I have a 4 rupee gain. Now, if you have a 4 rupee gain, then only to the extent of this 3 rupee loss is what we are saying that will be considered as an adjustment to the interest cost. This 1 rupee gain over and above this 3 rupees, that is actually an exchange gain to be recorded in your financial statements. All right, it's slightly, you got to remember some of these principles, apply the logic. That is very simple. If I would have borrowed money in local currency, I would have paid interest at the rate of 11%. I had access to this foreign currency market and I was able to borrow money in foreign currency, where I was only paying interest at the rate of 6%. So this 5% delta is actually my saving. Now I have saving here on account of interest cost, but because I borrowed now money in a foreign currency, I've exposed myself to an exchange rate risk. The standard suggests that if you are exposed yourself to an exchange rate risk, and if you have a qualifying asset which is out there in your balance sheet, then the exchange rate loss which you incur in relation to your borrowing to the extent of the interest saving which you could have potentially have if you would have borrowed money in a domestic currency, that should be considered for the purpose of capitalization as akin to an interest cost. And if in one accounting period you had an exchange loss, in another accounting period, if that qualifying asset continue to exist in the construction phase itself, and if you have a gain in the subsequent period, then the gain to the extent of previously recorded loss, that should get offset against each other, and hence you're going to capitalize in one period, you're going to decapitalize in another period. Over and above the loss which you previously recorded, the gain is much more than that, then that is actually an exchange gain which you will record in your balance P&L as a foreign exchange gain, and appropriately, of course, revalue that liability in your balance sheet as well. So we're going to further try and understand this with the help of this example, right? An entity can borrow fund in its functional currency at the rate of 12%. Functional currency is INR, and we will talk a lot more about the functional currency and foreign currency when we will discuss the concept under Ind AS 21. I will do a very detailed discussion on functional currency and foreign currency. It borrows $1,000 at the rate of 4%. So if I would have borrowed money in my functional currency, I would have borrowed money at the rate of 12%. I have access to dollar borrowing, and here I can borrow money at 4% when rupee dollar was 40. The equivalent amount in functional currency is nothing but INR 40,000, right? Which is 1,000 into 40 is 40,000. Interest is payable on March 31st. On 31st March 2020, the exchange rate now equals to INR 50. The loan is not due for repayment, right? Now the rupee dollar has moved from 40 to 50. It's a very, very substantial movement, right? 25% is the erosion in value of rupee vis-a-vis dollar, right? Now, the question is, when you look at this, right, how do you determine what is the extent of exchange loss which can be considered as part of your interest cost? The exchange loss in this case is INR 10,000, right, which is $1,000 into INR 50 minus 40 is 10 rupee loss per dollar, so which is 10,000 is the loss. The borrowing cost is INR 2,000, which is $1,000 into 4% into INR 50 is what I'm paying as an interest cost. Had the entity borrowed money in the functional currency, the borrowing cost would have been how much? What rate I can borrow money in my functional currency is 12%, right? I can borrow money at the rate of 12%. So if I would have borrowed at $1,000 at the rate of 40, right? How much I would have paid is 40,000 multiplied by 12% for 1 year is 4,800, right? 4,800. So now against this 4,800, I've already paid now interest of 2,000, which is at the rate of 4% multiplied by INR 50 prevailing rate on the date when it is due. The entity will treat the exchange difference up to INR 2,800. How much is the exchange loss I have here, right? My total exchange loss is 10,000 rupees, but exchange loss to the extent of 2,800 as a borrowing cost that is eligible for capitalization under this standard, right? So total eligible borrowing cost is INR 4,800, equivalent to the cost of borrowing in functional currency. That's the example and the concept. Let's try and understand this with another example, right? Scenario 2. If the exchange rate on 31st March 2020 is not 50, but it is 41, then what do I do, right? In this case, the exchange loss is INR 1,000, not 10,000, because rupee has only moved by 1, so 1 multiplied by 1,000 is what my loss. Now, if I would have borrowed money in the functional currency, my total cost still would have been 4,800, right? But here my total cost in my foreign currency is what the interest which I'm paying, which is 2,000 plus the exchange loss of 1,000. That means now the entity will treat the entire exchange loss as an eligible borrowing cost, not 2000, sorry, right? Because that 2000 was when the exchange rate was 50, right? Now here the exchange rate is also changed to 41. If the exchange rate is also changed to 41, I'm going to pay 1000 into 4% into 41 plus INR 1000, which is the foreign exchange loss. So my total is actually 2640. Right, because when you look at the 1000 into 4%, which is 40 into 41, right, is 1640, right? 1640 plus 1000, which is 2640, right? 2640. 2640, when you compare that to 4800, right? That 4800, because this 4800 was computed on the date of borrowing where the rupee dollar was 40, right? So 2640 is lower than 4800. So entire 2640 now is to be considered as an interest cost which is eligible for capitalization. Let's further extend this, right? If the exchange rate on March 31st 2021 is INR 48, right? The exchange rate on March 31st 2020 now was 50, right? We said 50. Now it has come down to 48. It has come down from 50 to 48. That means there's a 2 rupee gain from 2020 to 2021. The borrowings are still not due for payment. The entity will recognize a borrowing cost of INR 1920, which is 1000 into 4% into 48 for that year, right? For that year it is 1920, and then there's an exchange gain of INR 2000, INR 1000 into INR 50 minus INR 48. This will be adjusted in the borrowing cost as there is unrealized exchange loss, and the adjustment is less than the exchange loss of INR 2800 recognized in the earlier years. So the entire exchange gain of INR 2000, which is lower than the 2800 which we were allowed to capitalize, right? The entire 2000 will be actually be adjusted, in the accounting period. So what does that mean? What does that mean? That in this year, right? In this year, essentially my borrowing cost is 1920, and actually I have this 2000 of gain, right? So essentially I have 80 of benefit, interest benefit, right? Interest income, in fact, in this year, because there's an exchange gain and what I was actually paying. So this 80 will be actually reduced from the, so there will be no new capitalization of interest cost. In fact, what I've capitalized in the past, that is what also I need to take away, right? Where I need to take away, and that will reduce my, the carrying value of my capital work in progress from that perspective. Let's further look at this, right? Continue with the scenario one. If the exchange rate on March 31st, 2021 is INR 44. Remember, we started with 40, it moved to 50, and now we're saying we're back to 44, okay? So exchange rate on March 2020 was 50. The borrowings are still not due for payment. That means, so I'm going to just do it here. So on day 0, it was 40. We moved to 50, and then we are moving back to 44. That's the 3. And how much I had borrowed? I had borrowed $1,000. What is the rate of interest I had borrowed? I had borrowed at the rate of 4%. How much is the rate if I would have to borrow money in the functional currency? That information was 12%, right? I had to pay, if I were to borrow the same thing, 12%, right? Now, the question here is exchange rate on March 31st, 2020 being $1 to 50. The borrowings are still not due for payment. how much the entity then will look at as an interest cost. The entity will recognize a borrowing cost of INR 1760, which is 1000 into 4% into 44. 1000 into 4% into 44, that is 1760. There's an exchange gain of 6000, right? There's an exchange gain of how much? 6000, which is nothing but 50 minus 44, which is 6 rupees on $1000. 50 minus 44, which is 6 into 1000 is 6000. This says a 6000 of exchange gain, and there's a 1760 of interest cost. How much? Remember how much I was allowed to capitalize on account of exchange loss was 2800, right? 2800. This will be adjusted in the borrowing cost up to INR 2800, as there is unrealized exchange loss, and the adjustment of exchange loss recognized in the earlier year is of INR 2800. So my total exchange gain here is 6000. 6000 minus 2800. Right now, how much is left? Right? How much I am left with? 3200. This 3200 is the exchange gain that will go and sit in my profit and loss account. Right? Whereas this exchange gain to the extent of 2800, which I had previously capitalized, I'm going to again charge it to my capital work in progress, and I will not be allowed to record this exchange gain in its entirety through the profit and loss account. Only exchange gain in this example up to 3200 will go to P&L, whereas 2800 will be used to offset my capital work in progress, which was actually since I had capitalized that much exchange loss in the previous period. So it takes care of the life cycle of that qualifying asset if you have funded that qualifying asset with reference to a foreign currency borrowing, from that perspective. Now let's look at scenario 4. Continue with the scenario 1, right? Scenario 1, remember, we moved from 40 to 50, right? Now, and how much we had borrowed? We had borrowed $1,000 at the rate of 4%, whereas my domestic borrowing rate was 12%. Now, let's try and understand if the exchange rate on March 31st, 2021 is $1 to INR 44, and the part of the loan is now repaid. We are adding one more complexity, right? A portion of the loan has now been repaid. Exchange rate on March 31st, 2020 being INR 50, 600 of the borrowing was paid on March 31st, 2020 when exchange rate was how much? 50. So I have repaid $600. That means now for this year, only $400 continues to be outstanding, are still not due for payment, and the construction is still going on. The entity will recognize a borrowing cost of INR 704, which is on $400 at the rate of 4% at the rate of INR 44, which is the actual interest cost which I am going to pay in relation to the outstanding amount of loan, which is $400 at the rate of 4% multiplied with 44 rupee to a dollar. That comes to 704, right? There is an exchange gain now on this $400 at the rate of 6. There is an exchange gain of 2400. 400 multiplied by 6, which is 2400, is my exchange gain, right? Now the unrealized exchange loss or earlier year is INR 4,000 in relation to the outstanding loan. Please remember, in relation to the outstanding loan, the unrealized exchange loss was 4,000, right? Which is 400 multiplied by which is 50 minus 40, so to say. So this 4,000 was the unrealized exchange loss, right? Because when I borrowed money at 40, it moved to 50. So, and the loan outstanding is 400. So in relation to the outstanding loan, whatever I repaid, which is $600, the loss of 10 is actually got realized, right? The unrealized loss is in relation to the 400 is how much? It is 4,000, right? 4,000. Now I need to look at how much is I am required to offset here. Okay, how much I'm required to offset here, right? So is 4,000. Now the unrealized exchange loss of earlier year is INR 4,000, which is out of which INR 1120. Now how this 1120 has been computed again? You got to look at $400, right? $400, right? Which is 2,800 into 400 by 1,000 was charged in March 2019 as the borrowing cost. Or basically, if you look at on this $400, right, how much is what I have saved? How much is 50 minus 40, right? Which is 400 into 6 is 2,400, right? Now that is the exchange gain which is out here in relation to this. But the question you have to answer is that how much was considered for capitalization, right? Now what was considered for capitalization was only 2,800 rupees, right? Now this 2,800 rupees which was considered for capitalization, how much of that 2,800 rupees relates to this $400, right? So 2,800 into 400 by 1,000, right? Which is 1120, right? Which is 1120 is what you got to compare with this 2,400, right? So out of this 2,400, of actual exchange gain, which unrealized exchange gain in this current period, 1120 is going to be used to offset your interest cost, right? The balance, the 2,400 minus 1120, okay, this will be considered as part of exchange gain in the current period. All right, it's slightly complicated. But if you were to apply the whole principle at its simplicity, you will be able to get it right. Right? So now that is to be, thus there will be an adjustment to the borrowing cost up to INR 1120, as this is unrealized exchange loss. All right. I hope this gives you a full perspective in relation to some of the concepts around that what is actually borrowing cost, right? So several things which we talked in this section is that the recognition, the definition, right, as to for what purpose it is relevant, from that perspective. So what's the purpose of this standard all about? The purpose of this standard is to help you assess how much is the borrowing cost. Now once you determine borrowing cost, the question is that what portion of borrowing cost is eligible for capitalization in relation to a qualifying asset. So we talked about borrowing cost, when we talked about borrowing cost, we said any cost which you incur in relation to a debt which you have on your balance sheet. We also talked about exchange loss which you incurred in relation to a debt which you may have borrowed in a currency other than your functional currency. So to the extent of interest which you have saved in relation to your borrowing cost, which you have borrowed in a foreign currency, that is also forming part of your borrowing cost. And also we took example around lease. Let's say if there's even if it's a notional or imputed amount of interest in relation to your ROU liabilities, that also is eligible part of your borrowing cost. We also said if any return which you are paying to equity holders, that's not to be considered as part of your borrowing cost. Equity holders for instruments which are qualified and sitting in your balance sheet as part of your equity box. But if there is an equity shareholder which is given loan also to a company and also subscribe to the share capital, and on the loan you pay interest, now that interest is eligible to be considered for the purpose of borrowing cost. And then we talked about qualifying asset. What is a qualifying asset? Is something which takes substantial period of time in relation to its construction or for production, for it to be ready for its intended use. And the substantial period of time has not been defined in the standard, but it is generally presumed to be a period which takes more than 12 months. A period which takes more than 12 months. So once you've understood the concept of a qualifying asset, which could be building an office building or office headquarter or a factory building, let's say or if it is an inventory, which takes substantial period of time for you to build, like a ship or something, all of that in a way qualifies as an intangible asset. And this thing goes to the genesis of what is the cost which is eligible for capitalization under Ind AS 16 or under Ind AS 38 model for tangible asset or an intangible asset. And interest cost is also an eligible item of cost which is eligible for capitalization. Here under Ind AS 23 standard, we are trying to determine how much of that cost can potentially form part of the capitalization. There are certain scope exclusions which we talked about, which is to say that if it is a biological asset, you are not supposed, which is accounted for at fair value under Ind AS 41, they are not, these are not going to be qualifying assets. If the inventory is made in large quantities on a repetitive basis, they're also not eligible qualifying asset, which you need to consider. So there are scope exclusions, and we talked in detail that if there is a foreign currency borrowing and if there is an exchange loss which you incurred in relation to, or even if it's an unrealized or realized exchange loss, such exchange loss to the extent of interest saved on your, if you were to compare this with your potential domestic borrowing, to that extent, that exchange loss is also eligible to be considered as part of your overall borrowing cost. And we use several examples to explain you the whole scenarios as to say this. If you borrowed money when the exchange was 40, then it moved to 50, then how do you deal with that? If it moves to 48, then how do you deal with that? If it moves to 41, then how do you deal with that? So on and so forth. So we try to explain this with very, very comprehensively the impact of foreign currency, right? It's an area which is slightly complex, but if you were to apply the principle that exchange loss to the extent of interest saved, and interest saved vis-a-vis if I would have borrowed money in my domestic currency vis-a-vis the money which I borrowed in foreign currency, that exchange loss to the extent of interest saved is eligible to be considered as part of my interest cost. Now, if this exchange loss which I've incurred in one period gets reversed in the subsequent period, then that also is required to be reversed from the interest which was previously considered. However, if I have repaid that loan and that unrealized loss is actually got converted into a realized loss, then anyway there is no decapitalization which is required because it just got settled. In the future period, any loan which is outstanding to that extent, to the portion to which I had actually considered for capitalization, only to that extent, any other foreign exchange gain or loss over and above which is to be considered as part of Ind AS 23 is to be dealt with under Ind AS 21, and we will cover in more detail the assessment of foreign exchange gain or loss, or a foreign operation, or a functional currency or foreign currency. All of those concepts we will deal in detail when we will discuss Ind AS 21.